Hello and welcome. My name is Benoit Paliquin. I'm the founder and one of the portfolio managers here at Exponent Investment Management. Thank you for watching our 2020 year-end review. And let's get started. This video is the, I would say, medium length version of the video. For those of you that want to see the charts and all the work that went into it, please stay tuned for a longer video at the end of the current presentation. Let's get started, shall we? So let's take a look back at what really happened this year. What the reopening talks premature. We're going to want to know some of the questions that we've been asking ourselves. Where does the foot traffic exist in this new digital economy? The K-shaped recovery. So some people really did well during this pandemic, while others really suffered the brunt of this recession. Will tech continue to outpace the broader economy? We're going to talk about new trends and the acceleration of new ones. These are all things that we're asking ourselves as we're moving forward towards 2021. But first, let's look back at 2020. Effectively, diversification did not work in 2020. So the performance was largely driven about your weight in technology. So if we look at the NASDAQ, which is effectively all technology, the return in Canadian dollar terms was nearly 44%. The S&P 500, which has turned into performance in Canadian dollar terms of 16%, including dividends. And the weight of technology is roughly over a third of the index. We have Canada, which has some technology, but not a lot, turned in a return of 5.6%, and Europe, which effectively has no technology weight, turned in a negative return. Secondly, the US dollar had a pretty big impact. So we're trying to illustrate this here for you. So the return on the year for the emerging markets, which is largely driven by the Chinese markets, but also as emerging markets will tend to perform in opposite direction as the US dollar. So this 13.6 largely was driven by this quarter's performance in the emerging markets. The oil price is still down, but is up substantially. The VIX is still up from a year ago, but still had faded a little in a significant fashion in the fourth quarter. And finally, what we're looking at are interest rates in Canada and the US. They're still quite low by historical standards, and they are slightly higher from where they were pre-COVID. However, if you looked at this video at the end of the third quarter, the interest rates were close to 0.5% both in Canada and the US. That's where they bottomed out. As of the time of this writing, the interest rates in the US are over 1%. So what does that mean? Basically means that investors are starting to think about inflation. So we talked a little bit about the focused or performance. In other words, diversification did not work. So it's a mouthful. So I've got a couple of ways to illustrate this. So I've got a lot of boxes to go through. Let's go one by one. So if we look at this box, basically what I've tried to illustrate here is we have the S&P 500's performance here, roughly 16%. And then we have, this is in US dollar terms, and it is not including dividends. So what we've got here is an appreciation of 16% and 52% for the top 5 names in the S&P 500. So the 5 largest companies in the S&P 500 returned almost 53% in terms of price appreciation. It was as high as over 50% back in August. This is unprecedented. I haven't seen this in 20 years. Basically, you have to go back to the early 2000s in when the Tech 1.0 was hot. It's normal to see this type of sort of differential. It is not normal to see this size of differential. Said another way, this box basically lines up the best performing stocks in the index. So I'm excluding here Tesla, which joined the index in December. So we've got Apple, Amazon, Microsoft, Nvidia, and Facebook rounding out the top 5. And if we add up those 5 names, they gave us 55% of the return of the S&P 500. So you want to talk about concentration? You basically had to own 2, if not 3 of these names to have a hope of keeping up with the index. In Canada, much the same story. Shopify, a company that doesn't pay a dividend, and we'll go into a little bit of the ramifications of their metrics, gave us 200% of the index move. So the S&P TSX kind of has nearly 300 names, something around 300 names. And that the top 10 gave you most of the return. That tells you that there's 290 names in the S&P TSX that were negative. And this box said another way is if you, rather than have market cap weighted, if you had all the companies weighed the same, the equal weighted would still lag the performance of the published index by 3%. And it's a substantial number in terms of a lagging. It's notable. Let's look at the economic snapshot for a minute. The pessimistic view, viruses aren't slowing down as of the writing of this. The US cases are rising. Canadian cases are we're seeing UK, obviously Canada shut down, and the US spreading it. The US has decided to take another course of action. As of the time of this recording, the vaccine is or deployment is a slow process pretty much everywhere you look. The wealth gap continues to widen, and that's something that we're watching. A lot of it is actually due to just asset inflation in terms of people with assets have done, have kept their net worth the same or even increased it in some cases, while those without assets are seeing that gap widen, because if you look at someone that wants to buy a house as an example, house prices in Canada have appreciated substantially. Political turmoil, obviously a week ago at the time of this recording, we saw the U.S. Capitol effectively have an armed, I don't want to say invasion, but certainly armed demonstration. It was breached. There's also public fatigue around the health measures, and really, as human beings, we tend to look for culprits. So this virus, it's tough to get mad at a virus, so many are turning towards the health system itself in terms of displeasure. The optimistic view is a vaccine is here. It's unprecedented how quickly the vaccine has been developed. There are many vaccines being developed, and as well, a lot of work has gone into therapeutics of the implications, if you will, the health impact of COVID. We saw some countries like Israel have nearly 20% of this, as of the time of this recording, have nearly 20% of their population vaccinated. So there are pockets of absolute or great successes, I should say. Are we closer to normal? It certainly doesn't feel like it in the middle of winter here in Canada, but if we look at places like New Zealand, East Asia, even Australia, life is back to normal. Liquidity, there's a lot of liquidity, which is good for investors. Central banks and governments have, as we'll demonstrate in a minute, deployed vast amounts of capital. The mortality results and their economic impact, I hate to bring those up, but really the mortality of the COVID-19 is not broad-based. It's really focused in one age group. Again, I don't want to make it sound like we're making a light of the situation, but from an economic perspective, when a large portion, significant portion of the population really has no real health threats to or by this virus, it has an economic impact. So it's really the tack that we're looking at in terms of the mortality tables. A lot of these companies that we're looking at have improved their operations tremendously. And so if you think about companies that are going direct to consumers or companies that have developed tools to interact with their clients digitally as opposed to in person, those improvements will stick with us post-COVID. Let's look at some winners and losers of the past year. Technology, anything direct to consumer, and that we believe that's a trend that will continue post-COVID. Solving problems in the digital age. Really, the companies have been able to leverage technology to solve problems have been clear winners. Stay-at-home stocks, so think of leisure stocks or think of home improvement stocks, have done well in 2020. The bottom, foot traffic, anyone relying on a business to come in literally through the door, so whether it's restaurants, leisure, or entertainment, I should say, or things like experiences, so think of something like a movie theater, have been negatively impacted by COVID, and of course travel, entertainment, business travel, conventions. These are all businesses that have really suffered in 2020, and whether or not, it remains to be seen whether or not these trends revert post-COVID to the same extent. Crowded and confined experiences, live entertainment and cruises, those have been really decimated by this pandemic. And there's been a noticeable move out of downtown into the suburbs. So we've seen areas, whether it's Paris, Toronto, New York, San Francisco, these downtown cores have really been effectively relegated, or there's been an exodus out of downtown cores to the suburbs. And you've seen that in terms of mobility, traffic, and you've seen that in terms of... Let's talk about strategy a little bit going forward. Really, nothing has really changed. We want to keep an open mind. We want to remain flexible. We want to think in probabilistic outcomes. And we want to be able to steer or move, to steer the boat or the ship or the portfolio in such that we would have a tailwind. So we want to keep an open mind, flexible pivot, and really assess all the potential outcomes. Worse than expected, all the way to the to the best or better than expected outcomes. So really, you want to have an open mind or an open appreciation of all sorts of outcomes. And you also want to look at low probability with high impact, both to the upside and to the downside. So this is a slide that we introduced last quarter, and this will continue to be really our mantra on a go-forward basis in terms of portfolio strategy. So what hasn't changed in 2020, or going forward, I should say, in terms of our investment management approach? We want to continue to have a dividend focus, or at the very least, if we're buying companies that aren't paying a dividend, we want them to share the bounty or the profits by share buybacks. In other words, return profits to shareholders. We want to see quality balance sheets, so not too much debt. And if there is debt, we want to make sure that there's no solvency crisis on the horizon. We want to see proven management and battle-tested management and a proven business model. We will continue to have a global approach. So we will look at companies in Canada, the US, and beyond. And we will continue to have a valuation discipline. We want to buy things that are cheap, whether it's cheap versus the market, versus their historical valuation, or versus the market in general, or versus their peers. And the reverse is true. If they get expensive versus the market, versus themselves, versus their peers, we will be sellers. And finally, we will pretty much ignore the headlines. That's always been the case, and we'll continue to do so. So in most of your portfolios, in all of your portfolios, really, you will not see companies that are making the big headlines. We are not headline chasers when it comes to portfolio management. The adjustments we've made, well, rising interest rates and inflation, those are new. And so we want to sort of incorporate that into our thinking. Direct-to-consumer, I'm saying it again, this is really a game changer for many companies, and those that are able to either sidestep the independent distribution channel and go directly to consumer, or at least mitigate that, will continue to do well. Brands have proven themselves in this pandemic to be valuable resources, valuable properties or location, if you will. So very much in the real estate market, you want to buy the very best locations because they're usually the ones that are last to fall in terms of rent, and the rents are usually the fall in rents are less, and they're the ones that can pass on rent increases, and they're the first one to come back in a economic revival. So really view brands as moats. K recovery, that's going to drive our stock selection. There's a strata, the top economic strata that has done well, or at least kept pace during this recession, and there's the bottom strata that really has been hurt by this economic downturn, and that will drive our stock selection process. Government policies, they have driven and have made winners and actually created problems for whole industries or even certain companies. And on a go-forward basis, as we reopen in North America and Europe, the government policies will determine, will be an important piece in terms of determining the winners and losers. Let's look at the video, that charts and data that went into this video. So a couple comments here. We talked about the K recovery. So this is what we're going to try to illustrate here. So we've had bottom content, some industries in terms of the recovery, according to the U.S. Chamber of Commerce, have come back, and some industries that really haven't, are actually worse off than the last recession. So really, you want to focus on what's working right now, but you still want to keep an eye on the reopening, because this virus will eventually end. If we look globally, there's some parts of the world where there is, life is back to normal. So you want to keep, not only sort of assess what's working, what's not, but keep an eye on what will happen once the virus goes away. The e-commerce spending, clearly the pandemic has reinforced the strength and the importance of e-commerce. So we saw sort of the red line is the grocery. So we sort of had a slightly uptick trend line, and obviously this pandemic has exploded to the upside. So it will not come back, obviously. Will stay up, I should say. Will it stay as high as it has in the past? Probably not. It probably will come back, but I think that trend, it's safe to say that trend will continue along the same line. And all e-commerce combined, we're kind of seeing this positive swing as well. And in terms of foot traffic, we're seeing movie theaters and other sections like that, so call it malls, really hurt by this COVID-19 in Europe and in the US in terms of foot traffic. And then we're seeing other markets or other businesses, if you will, still maintain and go back and sort of hang in there, if you will, in terms of counter service restaurants and the like. And sort of the Walmarts of the world have kept up. And obviously we've had sort of, and these sections right here really take it on the chin. So that's what we mean by two economies at work, and in the correlator that would be the K recovery. Let's talk about pent-up demand, whether or not it is with us. So here's the savings rate here in Canada since 1960, and all of the government monies that have gone into the economy have largely been banked. We have to go back to when interest rates were 21% to have a high savings rate. So whether this money goes back into the economy at some point or simply sort of stays there remains to be seen. So the bulls are calling this a pent-up demand. The bears are calling this simply a reaction to difficult times in the economy. Another way to look at it in terms of calling or looking at money in the economy. So we're seeing sort of in the US and in Canada sort of the squiggly lines, but the trend up in terms of capital in the economy. And really, this pandemic, we see massive amounts of injections in the economy. So that's what we mean by a liquidity injection. Substantial, so up 18%. In terms of growth, substantial. And so the correlate to that is we've seen asset prices, whether it's Bitcoin, home prices, even stock prices, bond prices, most businesses, private equity, all of these assets saw their values increase dramatically as more money makes it into the economy. So our fear, many investors fear that all this excess liquidity has increased asset levels, but also will increase general pricing levels, otherwise known as inflation. Another way to look at it is to look at what central banks' balance sheet. So basically, we had the post-recession, and we slowly had sort of the yellow line is the Bank of Japan, the blue line is the European central banks, and you had them sort of get involved and slowly deploy more and more money into the economy. But starting in COVID right here, the central bank balance sheets have doubled. So another way to look at it is, if we're looking at $4 trillion going to almost $7 trillion in less than a year, and basically taking 19 years to go from $2.5 trillion to $4 trillion. So the sheer size and the sheer speed at which money was deployed in the economy is really why the markets turned around. Central banks, effectively during the COVID, the depth of the March crisis, central banks decided that they were going to get involved no matter what. So during the second quarter, what can we take back? Well, that's really the time when technology really, really took off. So here what we have here is, we wanted to illustrate that. So we have Zoom and Chevron as an example. So this, since the beginning of the year, Chevron is down 30% and Zoom is up almost 400%. Back in October, it was up almost, over 700%. But when you look at the balance sheet or the income statement, Zoom's cash flow is $1 billion and Chevron is $27 billion. So there is a disconnect. May not be a popular concept, but we would say that there's a complete disconnect between what's going on in terms of each of company's balance sheet and their market value or stock performance. Here we have Shopify and Royal Bank. So again, Royal Bank is effectively flat for the year, and Shopify is up close to 200%. However, the market capitalization of Shopify is $183 billion. Royal Bank is $153 billion. So basically, Shopify could effectively buy the bank. It's not that dramatic of an idea, but it's worth more than Royal Bank. However, the cash flow of the past 12 months worth of cash flow of Shopify is $232 million, and Royal Bank's is $57 billion. I'll say it again, $200 million in cash flow for Shopify, $57 billion for Royal Bank. So it's safe to say here there's certainly a disconnect. I know Shopify is expected to grow a lot, but is it going to grow in terms of cash flow to the size of Royal Bank? We really don't think so. Let's look at the third quarter. In terms of the big names, we saw oil come back. Copper has really, really turned it on starting in the third quarter, and really is up 12% in the third quarter, and in the last 12 months it was up 30%. So copper is often referred to as Dr. Copper, and it is forward-looking in terms of it's an economic input, and when prices go up in copper, generally that tells you that the markets are expecting better things ahead economically. Just like back then, you saw copper fall, even pre-pandemic. So there was an expectation here that we shared that there was an economic slowdown expected. Now this is an interesting one. It's the first time I show this, which is lumber. So price of lumber expresses in board feet. So we really, out of COVID, we saw $300, and this historically, this lumber prices generally hovered, and they were fairly stable. Part of the reason why I never showed it. Right around, let's call it $300 to $500, sometimes $600 was the peak. We really had nearly $1,000 in terms of peak. It fell right down as lumber supply caught up, and here we are again with another peak. So why does lumber matter so much? Well, it's a significant component of the cost of building a home. So if you're seeing inflation in one of the key inputs in home building, one would expect home appreciation to be driven up as well. So we know that housing prices are dependent on low mortgage rates, but in this case, and this is new for 2020, we're starting to see a significant appreciation in some of the input costs. We mentioned earlier, we're really looking at interest rates. So they bottomed out in the 0.5% range, both here and both in the US and Canada. And really, this doesn't look very violent, and we're nowhere near the levels that we were. But why this is important is that technology names tend to be considered infinite duration. In other words, most of their profit and their sales are expected a long ways in the future. And so the lower the interest rates go, the more the positive the impact is on technology names in terms of their pricing. And so if this should reverse, and we went back in time and you looked at 2001 and you looked at, you can go back to the 50s as well when technology names, and in the 70s when names did well, every single time rising interest rates is usually what killed the tech rallies. Here what we have in local currency is, or in these two charts, is really kind of a broadening out of the rally. So starting back in September, we saw the Russell 2000, which is really, and in the value bent of it, we really saw an appreciation in terms of up roughly over 33%, or up a third. So again, what we're looking at here is the differential between the S&P 500 and an equal weight of the S&P 500. So again, we're trying to take out the name selection and just to find out how weights are impacting the performance. So we saw at the end of the quarter sort of a peak, and we're kind of seeing this downtrend in terms of the rally being broadening out, meaning that the leaders that carried the 2020 performance are starting to run out of steam, if you will. We're not calling for a lot of these names to necessarily fail. We're just, actually, this is a positive outcome where we've seen rallies broaden out in terms of more and more names capturing the upside. Canada and the US in terms of performance, no real surprise here, except that here in Canada we saw really the tail end here, sort of an appreciation in the last quarter, and it continued. So while the TSX is really largely driven by Canadian banks and let's say financials and commodities, and we saw sort of a nice move up in the fourth quarter. In the US, we kind of saw a broadening out of the rally as well, but we also saw that the leaders of the previous time periods of 2020 continue or stayed up. Effectively, we didn't see a fade or a sell-off in terms of the leaders that rallied post-COVID. Here, what we see here is we're trying to ascertain where the economy is. So we saw a significant sort of downtrend in April and May in Europe, same in Canada, and the same in the US. And basically what we're seeing here is the economy in terms of industrial production is roughly running at 90% or 95% of where we were pre-COVID or this time last year. So while the economy has come back, it hasn't come back to the same extent. So, interesting here. So we're contrasting the Dow Jones and the NASDAQ. And again, we're not to beat a dead horse here, but basically the Dow Jones has a much lower technology content than NASDAQ. And so that has largely driven the outperformance in sort of the tech versus non-tech performance. Will that continue or revert in 2020? In 2021, that remains to be seen. So again, we've showed this before, but I just want to go through it again. This sort of market attribution where the top names in both indices largely drove the performance, and so diversification did not work in 2020. ETF flows, it's interesting to watch. We like to watch those simply to see where their money is going. So here we have the S&P 500, and over here we have the Canadian markets, I should say the US markets and the Canadian markets on the right. What is interesting to see, I'll try to get rid of this little, so we're seeing negative cash flows out of the spiders and out of the technology names, and we're seeing small cap names, IWN being the Russell 2000, and we're seeing sort of energy names increase in terms of attracting more cash flow. And the VTI here is also the broader index, the US index. So you're seeing clients, or not customers, but investors start to appreciate the problem with the S&P 500 in terms of concentration. So they're either moving to a more broader index, or they are moving to a out of technology and into smaller caps. Over in Canada, we're seeing ZSP, which is the S&P 500 sponsored by NEMO, but that it's hedged. That might be a little late as the Canadian dollar is appreciated. But also what's interesting to see is we're seeing some positive inflows into energy and some significant outflows out of the Canadian indices per se. So you're seeing dollars leave the broad indices, again, perhaps because the indices are focused or the performance is focused into but a few names, and either going into the laggards like energy or broader indices in the US, which are VUN and VCN, which are Vanguard-sponsored broad equity indices. So it's interesting to watch, and really it gives you an idea of where the money is going. It certainly is not a guarantee of future performance, but it's good to know where the money is going from a funds flow perspective. Here are the four markets that we track. We show you these charts every quarter. We've got the S&P TSX, XIU, if you will, so the top 60 stocks in Canada. We saw sort of one leg up and then a flat lining and then another leg up. Same here in the US, sort of one leg up till the middle of the summer, flat lining, and then we're seeing another leg up. Europe is over here, similar story. So we kind of, it's interesting to watch that the diversification really doesn't work because the markets kind of are all behaving the same way. One could probably surmise to say that a lot of this rebound is due to central banks' action in terms of flooding liquidity. And so all central banks globally are doing this coordinated effort. So it makes sense that the markets all respond in the same fashion. I like to show you these four charts every quarter. If you look at them, we're looking at VIX. So the VIX spiked back in March and spiked again during the election. We are still above 20. Let's just say that 15 is usually the level that most, a normal market would behave. So we're seeing that the 22 level tells us that there's still quite a bit of investor appreciation or expectation of future volatility. Certainly not to the same extent as back in March, but it's still present. We're looking at the Canadian dollar, obviously faded hard into the COVID crisis and rallied back, partly because the US dollar has depreciated, but also because commodities like copper, like oil, all things the Canadian economy produces have rallied. Oil prices, as of the time of this recording, were north of $50. Ended the end of the year slightly under $50. And so the prices have rallied back substantially, but we're still nowhere near pre-COVID levels. So traders might expect this run to continue based on the reopening schedule. Finally, gold. It rallied hard out of the COVID crisis. And even though we're expecting inflation, you're sort of seeing the gold prices below. They kind of gave up 50% or a big portion of their gains, I should say. But it's quite normal to see volatility around gold prices. It's not that liquid of a market, and so large transactions can have an impact in the short term on the underlying price of the commodity. Bonds, something very important to watch here. Two things really. The first one is we can see the white line is what we care about. That was the close of the year, and the red line is where things were a quarter ago. So we're seeing interest rates creep up, but are basically creeping up on the long end, and basically anything higher than 5 years has gone up. Anything below 5 years is slightly less expensive, or yields are slightly smaller than they were at a quarter ago. So that gives us a steep yield curve, so that's good for banks, and it's starting to, investors are starting to think about inflation. Over on the corporate bonds, which is the top white line, we're seeing substantially move down in price all the way through the curve, and especially even more pronounced in the shorter maturities. So again, this is good for corporations that are able to borrow at substantially very low rates. So that's good for the economy in terms of a recovery perspective or expectation. If we look at bond rates in the U.S., they've gone up on the government curve all the way through. Basically, the 3 years is the pivot point. And we also are seeing rates lower on the short end in terms of corporations. So corporations can borrow still at very, very low rates, which bodes well for an economic recovery. If we're looking at the winners and losers in Canada, we're seeing names that most people have never heard of. Chromium Therapeutics, Shopify, and Ballard. Obviously, Ballard is an interesting story because it used to be a tech darling decades ago. The rest of the names are sort of smaller names, except for Boralex and Canfor. On the negative side, we're really seeing energy, some pipelines, and travel, and cannabis stocks as the laggards. In the U.S., obviously, Tesla. I mean, it's an interesting move because Tesla was added in mid-December. The rest of the names, Etsy is a known name. The chip stock NVIDIA has done well. PayPal and L Brands, and obviously copper producer Freeport-McMoRan. These are fantastic numbers. What this doesn't say is how poorly Freeport-McMoRan had done prior to 2020, especially the last quarter is really when the performance turned around. On the laggards, basically travel and energy stocks is what has dragged down, or the worst performers in the S&P 500. So thank you very much for watching. That is it in terms of our year-end review. And thank you very much for watching. If you have any questions or comments, feel free to drop us a line. Have a great day. Thank you for watching.